Imagine waking up one morning and the system you trusted just stops working. Your bank is still there. Your money technically still exists. But no one is lending. No one is buying. No one knows who's about to collapse next. So everyone freezes. Companies can't pay salaries. Families can't refinance their homes. Retirement accounts start evaporating in real time. And somewhere, deep inside the system, a 158-year-old bank disappears overnight. Just like that. No warning, no safety net, no second chance. That was 2008, a moment so violent, so fast, it nearly shut down the global economy. Now here's the strange part. Look around today. Markets are up. Banks are bigger than ever. Credit is flowing again. Everything looks normal. But here's the catch. The crisis didn't end. It just changed shape. The fire was never put out. It was contained, redirected, buried under something else. And if you follow the smoke carefully enough, you'll realize something uncomfortable. We are not living after 2008. We are still inside it. This is not a story about mortgages. Not really. It's not even a story about banks. It's a story about something much simpler and much more dangerous. What happens when a system learns how to avoid consequences? Because that's what 2008 revealed. Not that the system was broken, but that it was incredibly good at moving the damage somewhere else. Here's how it works. When risk appears, you don't eliminate it. You pass it on. From borrower to lender, from lender to investor, from investor to another institution. Until eventually, no one really knows who is holding it anymore. And when that happens, the system looks stable, clean, efficient, safe. But it's not. It's just quiet. Think of it like pressure. If you spread it out enough, you don't feel it anymore. But that doesn't mean it's gone. It just means it's building somewhere you're not looking. That's what we're dealing with. A machine designed to take risk and make it invisible. A machine that didn't break in 2008. It worked exactly as intended, and that's the problem. It starts with something simple. A house, not an investment, not a financial instrument, just a place to live. For decades, that's what it was. You worked, you saved, you bought a home you could afford. The bank checked your income, your history, your ability to pay. If you failed, the bank lost money, so they were careful, very careful. But then something changed. In the early 2000s, money became cheap, really cheap. Interest rates dropped to levels not seen in decades. Borrowing suddenly felt effortless. And when borrowing becomes easy, people borrow more, a lot more. Now combine that with something deeper, a belief that owning a home isn't just practical, it's necessary. A symbol of success, stability, arrival. And that belief was everywhere. Ads, banks, politicians, all repeating the same idea. Why rent when you can own? So people stepped in, millions of them. Some could afford it, many couldn't. But that didn't stop anything. Because the system had already started to change. Banks were no longer asking one question. Can you repay this loan? They were asking a different one. How fast can we create it? And that's where the story really begins. Because the moment lending stopped being about repayment and started being about volume, the dream stopped being a dream and became raw material. At first, nothing looked wrong. People were buying homes, banks were issuing loans, money was moving, everything felt healthy. But under the surface, something fundamental had changed. Banks used to hold the loans they created, which meant one thing. If the borrower failed, the bank paid the price. So they were careful. They had to be. But then they found a way out. Instead of keeping the loans, they sold them immediately. Thousands of mortgages bundled together and passed on to someone else. Investors, funds, institutions, anyone looking for yield. And just like that, the risk moved. Not reduced, not controlled, moved. Now think about what that does to behavior. If you don't keep the risk, why worry about it? If your profit comes from creating loans, not from their success, then the game changes. Completely. Suddenly, it's not about, will this person repay? It's about, how many loans can we produce today? And once that shift happens, standards don't just drop, they disappear. Income checks become optional. Documentation becomes flexible. Reality becomes negotiable. Because the loan is no longer a promise, it's a product. Something to be packaged, priced, and sold. A factory, producing debt at scale. And like any factory, success is measured in volume, not quality. Now here's where things get creative, because once you have thousands of loans, you need to make them look safe, even when they're not. So Wall Street did what it does best. It engineered the problem away. Take all those mortgages, good ones, bad ones, questionable ones, mix them together, bundle them into something new, a financial product, then slice that product into layers, some safe, some medium, some let's not look too closely. These were called mortgage-backed securities. And then came the next layer, CDOs, structures built on top of structures, on top of loans, on top of assumptions, each step further away from reality, each step harder to understand, but easier to sell. Because complexity creates distance, and distance hides risk. Now here's the trick. Even if some of those loans were terrible, as long as most of them were fine, the whole structure could be labeled safe, very safe, AAA. The highest rating possible, given by agencies that were paid by the same institutions creating the products. Let that sink in. The people grading the exam were hired by the students, and somehow almost everything passed. So investors bought in, pension funds, banks, governments, all looking at these products and seeing stability, predictability, security. But underneath, it was something else entirely. A system taking weak foundations and coating them in confidence, like painting over cracks in a wall and calling it new. This wasn't risk management. It was risk in disguise. At this point, you'd think someone would step back, look at the structure, ask the obvious question. What happens if this fails? Some people did, but instead of stopping the system, they built something new. Insurance, or at least something that looked like it. Credit default swaps. CDS. On paper. Simple. If an investment fails, you get paid. Protection, safety, peace of mind. But here's where it gets interesting. You didn't need to own the investment to insure it. Let me say that again. You could take out insurance on something you didn't even have, which means you could bet on failure. At scale. Now imagine this. 10 people, all buying insurance on the same house. Not because they own it, but because they want it to collapse. That's what this became. A system where failure was profitable, and not just for one person, for everyone positioned the right way. So risk didn't just exist anymore. It multiplied, layered, expanded beyond the original problem. And sitting at the center of it all were institutions like AIG, selling protection, massive amounts of it, confident that not everything would fail at once, because historically, it never had. Until it did. And when it did, the system didn't just crack, it detonated. For years, the system ran on one simple idea. Housing prices always go up, maybe slowly, maybe unevenly, but never down. That belief wasn't just common, it was essential, because everything depended on it. If a borrower failed, the house could be sold. If the house could be sold, the loan wasn't really risky. And if the loan wasn't risky, then none of the layers built on top of it were either. Simple, clean, comforting, and completely wrong. Around 2006, something shifted, at first quietly. Prices stopped rising, then they hesitated, then they fell. Not everywhere at once, but enough to matter. And once prices started falling, the logic of the system reversed. Now do the math. You owe 500,000 on a house, that's worth 350,000. Your payments are rising, your equity is gone. So you ask yourself a very rational question: why keep paying? Many didn't. Defaults began to rise, then accelerate, then spread. One foreclosure became 10, 10 became thousands, and suddenly the market was flooded with homes no one wanted. Supply surged, demand disappeared, prices dropped even faster, and that safe system started feeding on itself. Because every default created more pressure, and every price drop created more defaults. A loop, tightening, accelerating, breaking everything in its path. This is where it breaks. At first, it looked contained. A few lenders failed, then a few funds. Then larger institutions started reporting losses. But markets are used to losses. They recover, they adjust. This felt different, because no one knew where the risk actually was. Remember, it had been moved, packaged, resold, repackaged again. So when things started failing, no one could answer a simple question: who's exposed? And when you don't know who's exposed, you assume everyone is. That's when trust disappears. Banks stopped lending to each other. Not because they had no money, but because they didn't trust the other side to survive. And when banks stop trusting banks, the entire system freezes. Credit is the bloodstream of the economy. And suddenly, it stopped flowing. Then came September 2008, Lehman Brothers. A 158-year-old institution, gone. No bailout, no rescue, just collapse. And with it, whatever confidence was left disappeared overnight. Markets plunged, panic spread, not just on Wall Street, everywhere. Businesses couldn't borrow, payrolls were at risk, trade slowed. The system didn't just weaken, it seized. Because in the end, it wasn't the losses that killed it, it was uncertainty. The system didn't run out of money, it ran out of trust. At that point, there were only two options: let the system collapse or save it. Governments chose the second: massive intervention, emergency programs, hundreds of billions injected into the system. Banks were stabilized, markets were supported, liquidity was restored, and slowly, the system started moving again. From the outside, it looked like a recovery, but look closer, because something strange happened. The institutions at the center of the crisis survived. Some even got bigger, stronger, more concentrated, while millions of people didn't. Jobs disappeared, homes were lost, savings were wiped out, entire lives reset. So you end up with a paradox. The system that failed was saved, and the people inside it paid the price. Now, to be fair, letting everything collapse might have been worse, much worse. That's the uncomfortable truth. But it created something else, something more subtle, a signal that certain institutions cannot be allowed to fail, no matter what, too big to fail. And once that idea becomes real, behavior changes. Because if failure is no longer an option, risk becomes easier to take, not smaller, easier. And that is where the story stops being about 2008 and starts becoming about today. After the crisis, everyone agreed on one thing: this can't happen again. New rules were introduced, more oversight, more capital requirements, more stress tests. On paper, the system looked safer, stronger, more controlled, and to be clear, some things did improve. Banks held more capital, certain risks were reduced. But here's the problem: the core mechanism didn't change. The incentives stayed the same. Profit still came from volume. Risk could still be moved. Complexity still made things easier to sell. And most importantly, failure was no longer allowed. So the system adapted, quietly. Instead of removing risk, it found new places to store it. Outside of traditional banks, inside shadow systems, across global markets. Harder to see, harder to measure, harder to stop. Because here's the thing, you can regulate a product, you can regulate a bank, but regulating behavior is much harder, especially when the rewards are still there. So yes, 2008 changed the system, but not in the way most people think. It didn't fix it, it taught it how to survive. After 2008, something unprecedented happened. Interest rates dropped to near zero and stayed there for years. Money became cheap again, not for the same reasons, but with the same effect. When money is cheap, it has to go somewhere, into stocks, into real estate, into anything that promises a return. So asset prices began to rise again. Not because everything was suddenly more valuable, but because liquidity was everywhere, abundant, constant, reliable. This created something new, an environment where markets didn't just grow, they expected to be supported. Every time something went wrong, central banks stepped in, injected liquidity, lowered rates, stabilized the system, again and again and again. Over time, this changes behavior, because if you believe that the system will always be saved, you take more risk. You rely on that support. You build around it. This is what we're living in now. Not a post-crisis world, a continuation, a different version of the same logic. We replaced toxic mortgages with something less visible. Dependence on cheap money, on constant liquidity, on intervention. It feels stable. It looks controlled. But underneath, it's still the same structure. Risk hasn't disappeared. It's just been stretched across time, across markets, across everything. Here's where it gets uncomfortable. The system today cannot be allowed to fail. Not because it's perfect, but because it's too connected, too large, too integrated into everything. Pensions depend on it, governments depend on it, entire economies depend on it. So when something breaks, you don't let it collapse. You intervene, you stabilize, you extend the system's life. And every time you do that, you solve the immediate problem, but you create a new one. Because the system becomes more dependent on being saved. It learns, adapts, relies on that support. Until eventually, you reach a point where the system doesn't function without it, where normal conditions are no longer enough. And that raises a simple question. If failure is no longer possible, what happens to risk? It doesn't disappear, it accumulates. Silently, patiently, waiting for a moment where it can no longer be contained. If you enjoy understanding global chaos in slightly less chaotic ways, you know what to do. Now, let's keep going. So what happens from here? There isn't one outcome. There are a few, and none of them are clean. Scenario 1. Slow erosion. No collapse, no dramatic crash, just persistent pressure. Inflation that lingers, asset prices that distort, growth that feels weaker than it should. The system doesn't break, it drifts. Scenario 2. Sudden break. A shock, unexpected. Liquidity disappears, confidence drops, and the system reacts faster than it can stabilize. A sharper version of 2008. Not identical, but familiar. Scenario 3. Managed illusion. The system continues, supported, stabilized, intervened again and again. No collapse, but no real resolution either, just continuity held together by constant action. 2008 wasn't just a crisis, it was a demonstration of how modern systems behave under pressure. They don't absorb risk, they move it, they delay it, they reshape it until it becomes something harder to recognize, but still there. Because risk doesn't disappear, it waits. And systems like this don't fail when they look broken. They fail when they look perfectly stable. If the system survived 2008 by avoiding consequences, what happens the day it can't avoid them anymore?